friends and associates. Welcome to Wealth Builders in Denver, Colorado. Scripture says in Deuteronomy 8:18, "Remember the Lord, your God, for it is He who gives you the ability to produce wealth." As men and women of God, we all want to succeed in our sphere of influence. We all want to make a difference in the kingdom of God. We all want to leave a lasting legacy for generations. Are you ready to be challenged? Do you thrive on inspiration? We all need a healthy dose of encouragement. You'll also receive expert instruction on proven and practical strategies and documented best practices. That's what Wealth Builders is all about. It's time to get off the sidelines and get in the game.
We are live, they told me. So we're Billy and Becky Epperhart.
We got no countdown.
And we want to welcome you to what we call the Navigating the New Normal, Saturday mornings at 10 a.m. We've been talking about the crisis that we're in, the coronavirus, honey, and how to take that crisis this time and use it, of course, for a kingdom opportunity. And so if you're just tuning in, this is your first time or whatever, we like to talk about how the current crisis is affecting businesses, investments, the stocks, for example, and of course, real estate. And so, and of course, you and your own job and you and your businesses and investments. So we try to relate those things and to you. We also, today, we have on with us Karen Conrad, who's our Vice President of Wealth Builders. Welcome, Karen.
Good morning. Welcome. Thanks for having me, Billy and Becky.
And we also have Mike Davis, who's one of our real estate coaches on with us. He's in Pueblo. I think Karen's in Dallas. So welcome, Mike.
It's good to be here with everyone.
And then I don't know if we have Dan. Do we have Dan on today?
Yes.
Dan's
hey.
on.
I'm here.
Dan.
Hi, Dan.
Hey. Well, welcome, Dan. Dan's one of our real estate coaches and does the boots on the ground for us. So say hello, Dan.
Good to see everybody. Looking forward to the show today.
Absolutely. Well, and so this is, of course, my wife, Becky. We've been dating now for 48 years.
A long time.
Long time. We've been dating a long time. And so she's got some things she's going to share with you today.
I am. First off, I'd like to take the opportunity to say Happy Mother's Day to those of you. See, it's a hint to him. Anyway, to all of if our mothers are watching, if not, this is a hint to those that have mothers. Remember, tomorrow's Mother's Day. Very special day. So happy Mother's Day. Also, we wanted to say, if you'd like to know current events of what we're doing, access our blogs. We do 1 or 2 blogs a week.
Yeah, we do 2 a week right now.
2 a week right now. And you can also access all the back blogs and much, much more. You can go to our wealthbuilders.org website and you can find out about anything there. That would be great. If you'd like to subscribe today to that website, or if you're, this is good. This has got cousin.
Oh, cousin.
If you're, you can find the free link and you'll access Lance Wallnow's Slingshot Strategy, which is what he taught at our Wealth Builders 2020.
Wow, I didn't know.
I know.
Like
we might subscribe to our own
Man,
website.
we may subscribe
just
ourselves.
to get that.
Just to get that.
So anyway, that's a link. It'll be in the email this coming week if you subscribe to that. Also, you can purchase the full video and audio of the conference, which includes all of the PowerPoints of the speakers, and that's at wealthbuilders.org/shop. That's a kind of something good to have in your library.
Yep.
Because as life goes along, you have questions and you think, where could I find that answer? Also, you can watch the previous live streams if you go on and at the banner, locate that, tap on it, and you can get last week's. Also, I'd like to say that our real estate workshop is full, but we also were doing it for the first time, our live stream, and you can go on and register for that, and you have a code RE100, and you will get $100 off the price. The price is $399. So if you have that code, put it in, you'll get $100 off. So it's $299. And so you'll be able to live stream, and it's always a lot of fun. I know, right? Awesome. And so next we want to say congratulations to Lena, who won the free Money Mastery book last week. Lena, we're going to have that in the mail and get that to you. So she won last week. So we're going to do the giveaway this week. I love this one. This is our Leadership Mastery Workbook.
Oh, wow.
It's backwards, but it says Leadership Mastery Workbook. I love this one. I love this one because you even have a chapter on the family.
On the family in here.
On leadership in the family. And it's some of the things I really like because, you know, you have to teach your children.
Yep.
Because they're going to be leaders in their family one day.
I always say the family is the home, and the family of the laboratory where leadership is really created and exercised and practiced and demonstrated.
So it's a great book. So go on, register for that, get in it, win it. Praise God.
Get in it, win it.
That's right. I know. That's pretty good.
That's pretty good.
So that's the Leadership Mastery book, the giveaway this week. Also, if you'd like to interact, we had a lot of good questions last week, babe.
Oh, I know.
And I know you did a really good job on the Wednesday 15-minute answer.
Yep.
So if you have questions, go down to the chat, type those in, and we will do our best. We will answer them live, or Bill will try and get to the rest of them on the Wednesday at 1 Mountain Time, Facebook Live.
Standard Time.
And also we have our girls in the background that are typing away. Their little fingers are just going 90 to nothing, but we will answer all of the questions. So if you have one, please don't hesitate. Type that in. We'll get back to you with an answer. Sometimes it takes a little bit longer because we do have so many, but please be patient. We will answer all of those questions.
And I think we've historically going back, we've answered every question over. It may take us several days on Wednesday to get to it, or maybe the following week. So
and you know, we really like your questions because I really like it because it sparks him. It gets him to thinking about things. And if you have a question, I guarantee you more than one person has a question, the same thing.
Yep.
So please do that. So anyway, that also thank you for those of you that have donated on our website. We really do appreciate that. Several have asked if you'd like to go on to our website and donate. Just click the donate button and it'll take you through all of that. Also, we have the app. You can go on your phone and you can type in the word give to 855-444-8056. And we thank you so much for those that have done that.
Awesome.
That's it.
Wow.
Over to you.
Oh, man, that's some commercials there. Okay, well, today we're going to talk about, and we're going to look at some graphs like we have in every webinar and live cast we do. So we're going to show you, we're going to start with the first graph that shows you March the 20th of what we call the S&P 500 SPY. And you can see to the right how far down of the graph, how far down the market came. The actual bottom of the market that we've seen to date was on March the 23rd. So this graph actually shows you how quick it came down, how quick it fell. And then we're going to go to March the 27th graph. You can see it then coming back up. And just so we're all clear, the market has, in fact, if you go back to the March 20th and 27th live streams that we did, we actually talked about the V-shaped recovery and the way the way it's looked coming back up so fast. If you see on the 27th here, we're showing you that graph. It bounced back up. Now this is the stock market. So most of the time, the stock market really is a thermometer, as I've been saying in these live streams. It's really the thermometer to show us the economy, but there's been a separation from it in the last several weeks of what the real economy is doing, what we call Main Street, and what's happening on Wall Street. I'm going to show you some more detail on that. But let's look at May the 8th chart, which is the last one we have for the S&P 500. And for those of you that may be a little new to what we're saying on this particular broadcast, the S&P 500 represents 500 stocks in the overall, the top 500 stocks in the overall stock market. And so it gives you a pretty true indicator of where the stock market is. And you can see when you look at the May the 8th graph, you can see the two bounces where it came up. It kind of went up, then it came back down, it went up. Now you can see it kind of moving sideways. It kind of got to almost to the 200-day moving average which is the black line on that May the 8th graph you're looking at. It came back up, and then you see how, and you can see how it's actually below it. If you look at it, it's right below the 200-day. That's what it's bumping up against. And so if it goes above that 200 moving day for a couple of days, then it's probably going to continue to go up. I personally think, and I'm going to give you some other graphs I'll show you, but I personally think that we're gonna go back down from that 200-day moving average before we actually go back up. Now, I want to just show you one. The next graph is a lot more succinct and clear on that. You can see, we call it the coronavirus comeback. You can see how the market came up. You can see clearly that kind of yellow gold line going across there, which is the 200-day moving average. And you can see how the market has kind of come up toward that 200-day moving average and gone down. Now, in just a second, I'm going to show you a graph that I've never shown you before. And this one is one of the more revealing graphs we've shown. What we're showing you now is kind of where the market is currently and how it's behaving. But now I want to show you the disconnect. This graph will show you the disconnect between Wall Street and Main Street. If you look at the top up there, you actually see the red, which the red piece of the graph, which actually is showing us the economic data that has happened to us, and that, for example, unemployment and other things, just what's happening on Main Street. And then if you look at the green graph down below it, it shows you, you can see the bottom there on the 23rd of March. You can actually see that little 23 there. And then you see how the market has been coming back up. Well, whereas our regular economic data is below the median, right, so to speak, you can see how far below it. You can see how the market has actually gone up. And so the market has, from below, whereas the regular economic data shows you that from below, we actually have started coming down. And so what that means is, and that's adding everything up to what we call the gross domestic product, unemployment, all those pieces are mixed in that to show us kind of the economic data of where we are. And so I just want to show you the disconnect between Wall Street and Main Street, so you get an understanding of why I've been saying some of the things that I've been saying to you in the last several weeks on this broadcast. In a minute, now I'll tell you in a few minutes what that means to us, okay, and what that would mean to you in your situation. But there's definitely a disconnect. Now, I want to say this, and I don't want to sound like I'm talking down to anyone who's watching or anyone who sees this later, or to even those in our team. But I know for me, this is one of the most important graphs I have ever shown on here, this next graph, that I've ever shown. And this one really, to me, reflects. So people will say, well, if there's a disconnect, honey, to this, if there's a disconnect, then the question becomes, how does that affect me? But why is there a disconnect?
That was my question.
Yeah. So why is there a disconnect? So I want to show you this next graph. This to me is the number one reason there's a disconnect between Wall Street and Main Street. So what you're seeing there in the blue line is actually the S&P as it has responded, and you notice that's in the blue line. Okay, so this is the stock market. It's called the forward PE. So what happens is the stock market normally looks ahead about 3 to 6 months, and it will, in its mind, price in kind of where it thinks the price to earnings is going to be. And what price to earnings is you just take, for example, the earnings of a particular company, say Microsoft, and then you divide that earnings by the number of what we call outstanding shares, and it gives you what we call the price to earnings ratio. The best way to understand price to earnings is thinking about rent on a piece of real estate. When you get your monthly rent and then you add those 12 months up and you get, okay, this year I made, I don't know, I'm just going to pick a number. I made $10,000 in my rent, right, on a $100,000 house, let's just say. And so your earnings well, you wouldn't have a net earnings, but we're going to use it for a round number. Basically, 10,000 into 100 would be a PE, a price to earnings of 10, right? So the normal stock market usually has a price to earnings of 15. A healthy, good median that you see in the stock market going back for many, many years has been a PE of 15. Now, right now, we're way over that, just so you know. So our price to earnings are out of whack, but I want to show you why. In other words, the stock market currently, based on the price to earnings ratio, is way overinflated in value. And so it's well above, way above 15. The red line, though, shows you really the Fed stimulus. It's actually showing you how much the Fed has actually put in, how much money, how much liquidity, so to speak, that the Fed has put into the market and into the economy, which has then affected the market. Now, I find it interesting that the Fed stimulus has of course, skyrocketed. That's the red line. You can see that. And you notice the stock market has tracked right with the Fed stimulus. I mean, exactly with it. Now, the reason that I'm showing you this graph is because right now, the way the market is behaving, it becomes somewhat of a false indicator, because what we're doing is we're doing what's called printing money. So we're printing money and we're putting that printed money into the economy. You know, if you got a stimulus check, for example, as an individual or as a business owner, you were able to take the PPP loan. So all of that, plus the Fed, are you with me now? They've been buying bonds, and lately they've been actually buying what's called on Wall Street junk bonds. And so they're buying bonds, junk bonds. They've even talked about putting money into ETFs, exchange traded funds. So there's a lot of money coming into the market in different ways. A lot of individuals actually this month in the S&P 500 in the last week and a half, there's been more money that has been withdrawn from many individual investors or different kinds of investors that have actually pulled money out, even though there's still money going in because people are buying. So the point is, we got to be careful right here, because in getting a false sense of where we are. And so I think there's a problem. Now, so the question is, why is there a disconnect? Right. That's the question. So if we're going to talk about that here in this particular live cast and live stream, we would say the first reason for a disconnect is because there's been so much Fed stimulus money. Now, in fairness, on the Fed side, they really haven't had a lot of alternative. You can either let the economy crash, right? Or you can help, do a balancing act to try to keep it going and keep, money in people's pockets and keep families fed. So that's what's been going on. But the reason I'm showing it to you is because there's a disconnect really between Main Street and Wall Street, in my opinion. And then the second reason that it's been going up is what I mentioned to you in one of the live streams. I believe it was either last week or the week before, what we call the FANG man stocks. And we'll show you the next slide here. I want you to see the slide. It's a good slide. Not this one, but the next one, the next slide, this one. The FANG man stocks are Facebook, Apple, Netflix, Google, Microsoft, Amazon, and NVIDIA. And those stocks really are the ones, first of all, those 7 stocks represent a very high portion of the S&P 500 comparatively to the rest of the stocks. And then because of that, these stocks have all done well during this coronavirus, right? And so as you see these big stocks, they've done well during this virus. And so what they're doing is they're pulling the market up. So we have Fed stimulus money that's coming in. We have these 7 stocks that are literally doing well. In fact, the NASDAQ today, and the NASDAQ, of course, is what we call primarily technology stocks. The NASDAQ is actually ahead of where it was for the year. So it went down just like the S&P 500, but it's actually come up to the top because it has many of these technology stocks that have done well in that particular index, right? And so I'm just showing you, I'm giving you 2 reasons, the Fed stimulus and these bigger stocks that are pulling it. So then the question is, well, that's all good, Billy, but what does that mean to me? So, I just want to show you. So these next couple of slides are they're meant to kind of show you how this works in I guess you would say in the real world. But you can see here we have what I call on the left the valuation, and then on the bottom we kind of see where the market. You can see the smart money is down. Institutional investors are next, and you can see the sell-off here on the red line. See that? Mm-hmm. And you see what we call a bear trap, and then the media starts talking about it, and then we start coming up, and then all of a sudden, everybody thinks the market's going to go, it's going to keep going like a rocket ship, and all of a sudden you come to a new paradigm. People start realizing, which is where I think we're getting to now, is the reason I'm taking the time to show this. Mm-hmm. Is you all of a sudden there's a new paradigm. Wow, that this coronavirus really has affected our economy, right? But then we still think, you see the word bull trap down there, it's talking about a bull market. And so we think that the market's going to keep going up, and then all of a sudden it keeps going down. You see fear. And then the word I want you to circle in your mind is capitulation, because that word really means that's when you get to that capitulation, what happens is everybody, the media, the Main Street, everybody realizes the market is now going to be in a tank. And then when it does, it comes down, and then it'll start, once it hits that next bottom, it'll come back off. And I'm showing you this because I think this is where we're headed. that we're actually going to experience the downside of this thing.
Is there good news?
Yeah, there's good news. The good news is people ask me what to do, and I'm going to show them. I'm going to tell you what to do. First of all, a lot of you, if you've been in the market for a long time, I have another slide I don't want to put up right now, Derek, so just hang on. But I have another slide that shows you if you just stay in the market and just hold on, if you've got a lot of your retirement funds or something in the market, don't sell, just stay patient because it will come back, right? I'm trying to show you what's happening short term. But long term, the market will come back. Now, if you're already in cash, then stay in cash. For some of you that are a little more sophisticated and you want to be a little more active and you know what to do, for example, in shorting the market, I'm not telling you to short the market. I'm just saying if you know how to do that, then that could potentially be a good play. And I would use probably options to short the market so you don't have to risk a lot of money. There's other ways to do it, but that's not really the purpose of what we're teaching today. I just want to kind of show you where we are and kind of the mindset that people are in. My concern, the reason I'm taking the time to say this, in a second I'm going to talk about real estate. The reason that I'm taking the time to say this is because I want you to understand, I think there's been a major, major disconnect between Wall Street and Main Street currently in the current environment. Now, what I'm going to do, Derek, is I'm going to skip a couple of slides for a second, and I want to go to the slide 11 if we can. I want to show you the percent job losses in the post-World War II recessions that we've had in this country, because we're actually in a recession by all economic indicators currently. Now, if you'll look at all these scribbly lines here, these represent the different recessions and the unemployment we had during those recessions, right? So the last one that everybody knows about mostly is the Great Recession that really began in the end of 2007 and took us, really into 2010. You can see that unemployment there got down to over 6%. You can see the bottom of that blue curve, 2007 unemployment recession. The red line on the very far left that's dropping, like a heavy rock, you can see how fast unemployment has gone down. I mean, look at this. It's gone all the way from zero here in this particular slide in the recession to 14%. Now, I'm going to show you another one here in just a second to give you the absolute update. But I want you to see, because of this coronavirus, we've never had unemployment like we have right now.
We've never been locked down, though.
We've never been. No, this is the first time in history. Yeah, so we've never been locked down. But my point in showing this is sometimes you don't understand the gravity of what's happening. Now, listen, I'm not trying to be negative but I do want to say that I don't know that you're going to be able to turn the economy back on like a spigot. Now, I do believe people are going to come back, and people have been getting, checks in their account from the Fed stimulus, and businesses, many businesses anyway, have been able to take the PPP loan. But there are people in Main Street that are hurting from this particular virus that we're in. And this is showing you dramatically the comparison of, and when I remember now, this graph is only showing 14%, right? Now let's go to the next graph for a second. And this one is showing us the industries that have been the hardest hit. So you can see leisure and hospitality, which of course would include restaurants. You can see how much unemployment has come in those, but then you can just go down and look at the chart. You can see education and health, and then others. You can see retail. So unemployment, and this gives you the industries, the categories of where people have been unemployed. But now let me show you the next one. This is dramatic. We showed you the 14%, but let me show you how much this means. We've had 33.5 million unemployment insurance claims in the last 6 weeks. So in the whole expansion under President Donald Trump, the whole expansion that we had since the Great Recession has been 22.4 million. Of course, that overlaps going back to President Obama, but you can see we created 22.4 million jobs since the Great Recession. Only 8.7 million were lost during the 07 to 09 Great Recession. Right now, we're at 33.5 million jobs that have been lost. Now, that's the reason for those of you that are watching here, not only when we start talking about real estate, which we're going to do, and I think I'm out of time. Am I out of time?
You're getting close.
Yeah. So I just want you to see that particular graph to let you know when I tell you that into the fall, mid-fall to late fall, there could be people could start realizing sellers in the market, which I've given you many graphs. If you go back and watch the previous videos, you see all the graphs I gave you, that when you look at that you'll understand and see and know that there is, I think you are going to have an opportunity to buy real estate at softer prices than we're seeing right now. And so I believe that's going to happen. Some of these, it's going to be like a ripple effect I mentioned before. So I have other slides, but I'm not going to go to them because we're out of time. And
Well, can I just say something?
Yeah.
Since we're talking about kingdom things, I would like to encourage those of you out there, if you have the means, do something to help the people that are out of jobs.
Absolutely.
If you had like a hairdresser and you're finally able to go and have your hair done, let's remember the days that we missed, and maybe we can catch up. Give them an extra big tip. I mean, these people are working hard, and now all of a sudden they have no income. If you have someone that comes and cleans your house, we keep paying the lady that comes because it's not her reason why she's out of a job, And so if you can do some things like that, let's do that. And then just tell them that you're doing this because, the love of the Lord, or you just want to bless them. But let's get that out there and let's help these restaurant people. Let's try to go by and every now and then, go by the restaurants and help them out.
Yeah, buy something.
Yeah, we need to do our part instead of just sitting at home.
Well, I think we do need to know there are people hurting.
There are.
Even with the stimulus checks.
Not because of anything they've done.
Right. Yeah, I mean, obviously, that nobody's the person to blame at any level. So I think that's important. And Dan, I think I see you there. Do you have anything you want to add or say here with what's going on?
It's been kind of weird in my area. Like 2-3 weeks ago, there were good deals on the market. And right now, it's almost like there is such an inactivity in real estate. I mean, I'm actually looking to buy homes. and it's like it flatlined about 3 weeks ago.
Yeah.
And so I think people are just hunkered down and sitting tight and trying to sit on their cash and trying to not make any drastic moves until they really figure out what's happening. And I agree with what Mama Becky, Happy Mother's Day, I agree with what she said about paying forward. I got a bootleg beauty consultant. I have a lady that comes over and cuts my hair, and me and Melanie, we just decided we're going to pay double, to help people as much as you can.
Absolutely.
There's
But
creative
yeah,
ways.
as far as real estate goes,
Mm-hmm.
Yeah, I think that's good. Well, you remember we showed last week that new listings actually have fallen off down to about 22%. And so the active listings have fallen off by 22%. And so
I'm feeling it here.
yeah, so I think people are hunkering down. So Karen, I'll give it to you and see what questions and comments we have. Go
Sorry.
ahead.
Great. We've got a lot of great questions coming in. If I could just comment on real estate,
Absolutely.
Texas opened up this last week. So we did what you're describing. We went to a restaurant and, tip people. But I'll tell you, as soon as Texas made the decision to open up, I watched the listings and they were popping. So it was like it turned a faucet on here. And we live in the Dallas area, so I can't speak to all of Texas, but I saw homes come on the market at a faster pace than I've seen for weeks, and I saw them go under contract within a day or two. So I'm not sure, we'll have to watch long term to see if that's a trend that we can rely on, but that's what's happening here in Texas.
Yeah, that's good. That's a great update. Thanks, Karen.
Yeah, so thank you. I just want to remind everybody just again about the real estate workshop. It is June 12th to the 14th, and we are offering a great price on the live stream. We've had some great response, and I think during this time, just to kind of hear what real estate looks like, I'm sure we're going to have a lot of updated content. So to take advantage of that, go to wealthbuilders.org and you can click on events and use the code RE100 and you can attend for $299
Oh, that's
for
great.
$100 off.
Yeah.
All right, let's get started on some questions, and just remind everybody, if you've got questions, go ahead and enter that in the chat or the Q&A on the Zoom. We've got a nice group of people on Zoom. We want to welcome you and thank you for joining, and also to encourage you to share this with your friends. This is information, I tell Billy and Becky this all the time, they have information that no one else has, bringing the kingdom and the knowledge and experience, and it's such a blessing. It's going to really help us over the next weeks and months to come. This first question is from chat, and Billy and Becky, the question is, if you were to acquire a business at this time, hoping to acquire it at below market price, what type of business would you look for?
Well, that's a great question. Well, right now, of course, if you're looking to get a good price on a business, you obviously would be looking at businesses, number one, that you think are going to experience a rebound, but currently they're suffering because of the particular economic condition we're in. And let me say something about that. What I learned in real estate many years ago was I had to get out of the mindset that I was taking advantage of someone. And we always worked hard at making sure we didn't take advantage when we were buying if there was really an unusual situation. But most of the time, if you have the ability to purchase something, then you can really make it a win-win. Now, I'm not talking about overpaying for something. I'm talking about being fair about what you're doing. But the flip side of that is, if someone is really hurting, there are people that want to get out of it. They don't want to be in that business anymore. Or there are people that, for health reasons, just all kinds of reasons. And so by going in, I just want to make that clear, because we want to operate from a kingdom perspective, that when we talk about these things, we're not trying to take advantage of someone. But I would look for businesses that, number one, are hurting now, but number two, have great prospects in the rebound. Warren Buffett said it last Saturday when he did his normal, I started to say call, but when he has his normal stock people's meeting that he brings them in. Of course, he did it on Zoom this time. But the point was that he said, you can bet on the American economy. And so I think as long as you find those businesses that have a good upside of us coming out of this coronavirus, and you can find good value there and make it a win-win for someone, then, then I would do that. So people say, okay, what kind of business? Well, I just showed you a graph that showed you where the hospitality and leisure businesses were hurting. Those businesses are going to come back. Now, I know some during this coronavirus will go out of business just because of the economic hardship. But we're talking about the future now. The future, when the American economy comes back in this situation, those kind of businesses you probably could find the best value in the leisure hospitality, and then look for ones that are going to parallel or be in the new trends that are actually coming. And so, for example, I believe, like right now, they're prophesying doom and gloom a long time for the cruise industry. But the truth of the matter is, I think long term, the cruise industry is going to be fine. And listen, people aren't going to quit going to restaurants. Now, there are restaurants that have already shut down. I've seen several high profile ones, but people are going to keep doing that. So the travel industry, the leisure industry, they're going to come back. They're the ones that are hurting the most right now. So if I was looking to really get a deal in business to purchase one, I would look for those kinds of businesses. Now, there's other kind of businesses that service that industry that are separate from travel and leisure that you may start looking in as well. So, and boy, we can, we need to do a live stream sometimes, Karen, on how you look to value a business when you're looking to buy it. What are you looking for? What kind of things that you want to watch out for? We need to remember to do that.
Yeah, that's a great idea. Thank you for that information. I just love how that ties into Wealth Builders and the purpose of building wealth. And so that would be great information. I just want to give a shout out to Jeff Summers, Billy and Becky. He had his gallbladder out yesterday and he's on the live stream today.
You're kidding.
You're kidding me.
Oh,
Jeff, we read your testimony last week,
we
Jeff.
did.
It was awesome.
He doesn't want to miss this on a weekly basis. That's great.
Well, take it
God
easy.
bless you. Yeah.
This is a question from, I hope I'm pronouncing this correctly, Timodeo David. And the question is, our company received the PPP loan and we are wondering if we should just apply the 75% rule to the amount we were given for payroll. And he says, thank you.
Well, I think the rule is kind of it's forward looking in the sense that you have to keep that payroll that you borrowed continuing to move forward. And so, for example, we just had someone in our office who is leaving and going back home. And so that obviously that payroll is, and so we're looking to hire, we're interviewing to hire. But basically what I've already heard this kind of through the grapevine from some people that I've been around, there are some people that have taken loans, PPP loans, and then actually have let some of their employees go, so to speak, during this time. And the whole purpose of the PPP loan is to keep your employees and keep them paid so that Main Street doesn't hurt in the sense of the level of unemployment claims that we're seeing right now. So I don't know if I answered that for them, but it's that 75%, you want to make sure that you're keeping your people employed.
Awesome. Thank you. Here's a question from Chad. It says, I saw in a recent news report that 80% of the unemployment claims are temporary. Do you think that's accurate? And if so, when do you see those bouncing back?
Well, I think that I guess I'll answer that. But yeah, I do think they're temporary. Here's the kicker. Here's the nuance, or if you want a nugget, here's a nugget. The nugget is how quick can some of those businesses get back up and running, because we don't know yet how people are going to respond to the economies opening back up. So, for example, I mentioned cruise ships a while ago, or you can take airlines. We don't know how long that people. I know there's people that are flying now that weren't flying during the heat of this thing, but we haven't flown, and I usually fly well over 100,000, 150,000 miles a year. And I've only been on one international trip this year. So the key to that unemployment piece of that 80% is how quick the American people, and really this is global, by the way, so
Can get back
I
to
say
work.
it's how quick they can get back to work, and people will actually do business with those businesses that they're going back to work with. So that's the thing that we don't know. Long term now, we're going to be fine. But for the next, 12 months or so, as we look at this, that's where the seriousness of the matter is.
Great. Okay, this is from Judy Langveld, and this is a little bit of a broad question, but I think you can give some good direction to Judy. Have you any tips on organizing a business enterprise? You are an entrepreneur. Can you give me some advice?
Judy, is it Judy?
Yes.
Yeah, Judy, I'm assuming when you say organizing the enterprise, I'm assuming you're referring to the legal entity. Is that what it sounds like?
That's what I would assume too.
Yeah, so basically, Judy, there's a couple things you need to consider. The two things you always consider is what we call liability, right? How do you protect yourself going into business, legal liability? And then the other is taxes. Most people who start small businesses now will actually start an LLC, which is a limited liability corporation, and then they will elect to have that LLC taxed as what we call a corporation, which would have the same kind of tax benefits that an S Corp would offer. So you basically would start an LLC, and it depends on whether you want somebody in it with you. If you do, it would be like what we would call a 2-member LLC, and you as the owner, like Becky and I, we have 2-member LLCs, and so I would be the managing member, and she would be the other member, but we own it equally, so to speak. But if it's a single member LLC, that's fine too. And then you can elect to have that taxed as an S Corp, because that would give you as an individual actually greater advantages than. And now if you're going to be a real estate investor and you're going to move there, then my opinion would be you would get what we call a 2-member LLC. Hopefully you and your spouse or you and a partner, and then you would have that taxed as a partnership. So it would be taxed differently than what the LLC. So if that was an entity question, now, listen, if you go talk to an accountant, they're going to tell you to start an S Corp. You go talk to a lawyer, they're going to tell you to start an LLC. So what you try to do is take both of them and get an LLC taxed as an S Corp. And unless you're investing in real estate or some other type of hard asset, then you may want to actually have it taxed as a partnership.
Now that was a mouthful.
Yeah.
Is there something we have on our website that someone can go to and slow all that down and read it?
Well, first of all, I'm not an attorney and I'm not an accountant. And so I just have experience, of course, in those things. And so, first of all, I advise you to talk to your attorney and talk to your accountant about what you need. And so I'm just sharing with you general things that you could do. But there are, I believe we have some blogs, if I'm not mistaken, on our website. And by the way, let me just say this. There's there's several thousand blogs, written blogs on our website that absolutely totally free. You just go on there and read them. And you go to wealthbuilders.org. And I mean, there's a lot of them. And so I believe we have some on legal entities that are on there as well.
Good.
Yeah, that's a great question, Becky, because it is overwhelming. There's also a search function on the website. So if you've got a topic that you're interested in, go to wealthbuilders.org and enter the keyword in the search function, and all the related blogs and vlogs will come up. Also, Billy's got a YouTube channel. So find Billy Epperhart on YouTube, and he's got all the video blogs. A lot of teachings are out there completely free. So definitely take advantage of that.
Amen.
This question is a great follow-up to that last one, and this is from Edwin Petty. He says, can the master LLC of an LLC tree be my existing LLC? It sounds like a brain teaser here, but I know you're tracking. That's used for his other company. And what he would like to do is create an LLC for real estate investments, or should that come out of that tree into a brand new tree for real estate?
No, it's fine to keep it. If you have a master LLC, it's fine to, you can create a second tree coming out of that master. It's all going to flow back up to this master anyway. And so one of the things that we're teaching now in the real estate workshops, and of course we Bill Bronchek, William Bronchek, Bill Bronchek, you can look him up on the internet. He's been a best-selling author in real estate. He participates in all of our workshops and that kind of thing that we do in real estate. And one of the things, I'll answer this question by saying, one of the things that we've been doing lately is you can have a master LLC, and then you can have maybe your investment LLC, for example, you're talking about for real estate, and I'd probably make that a 2-member as well. I have to think through that. It could be a single member with no problem, but underneath that, we're actually holding properties instead of holding them in LLCs now. We're actually holding those in land trusts. And so there's a whole teaching that we do in the real estate workshop on land trust as well, and how you create that. And I don't know, Karen, if Dan or Mike want to jump in here on some of that.
Dan, go ahead.
Just to clarify, I know you have always taught us about, the LLC tree. Is there any difference between that, for clarification, on a series LLC?
No, the way the tax consequences can flow in and out of that, honestly, the land trust is just a little more, from a liability standpoint, it's a little more innocuous, but an LLC protects you. And so I've always believed in the LLC tree, where you have a master and then you have single member LLCs that are underneath the master that you may hold, say, anywhere from 1 to 3 properties in every single member LLC. Now, I can get more sophisticated even than that, and that's where the land trust comes in. What the land trust does is it really protects you more, in my opinion, from a liability perspective, and usually they're pretty easy to create. In fact, all property that we now have, we put it in a land trust, and then we have an LLC, of course, above that owns it, that owns the land trust.
Great. Thank you so much. I just want to mention, and we'll have the date solidified for everybody, but we do have a business mastery workshop that is coming up in a few months, and you'll have the opportunity to sign up for that. And that's where, with some of the questions on the business setup, that is including real estate businesses or just businesses, we will be covering the information in detail there. And that will help people, even like Judy, that had the organizational questions. So more to come on that.
Yeah, because just let me say that I didn't know where Judy was coming from. So she's, we have the whole program called Organizational Mastery, yes, on how you actually organize and build structure for a business, which is separate from talking about the legal entity.
Yeah, very good. Thank you. This is from Sarita Jackson. This is a real estate question. I am now a renter. She says, I'm so tired of renting. We signed a short-term lease this time, which is up in 2 months. Is this a good time to buy? Are there any tips you can give us on buying a home at this time?
So Mike or Dan, you guys want to?
Go ahead, Mike.
Well, I know that Billy and I have talked about how the real estate is kind of lagging behind. There is a disconnect between it and the economy right now as well, and that the real estate market will probably soften up toward fall and even toward later this year. So I don't know if you can hang on for, I know you said 2 months, but if you can hang on a little bit to see a little bit dip in the real estate market so you can purchase. But the ultimate thing is this. I always make sure to tell people, no matter what signs you see in the economy or whatever, you need to make sure that you're being led on the inside, because God can sometimes go crosswise with what everybody else is doing.
Yes.
Good word.
Very good.
That's really good. I do think that different markets are going to be different. So get that real estate agent that has a good understanding of your market. There could be some areas that are going to perform way worse than other areas. And so there could be some good deals out there in strong markets. Or in some cases, if this really takes off with recovery, you could see things continue to climb. So That agent's really important. This is a great follow-up to that. Chad McCauley says this: I've been looking to invest in real estate, mainly looking at a fourplex or multifamily properties due to the local market in Northern California. My question is, we have the option for a property that we can get a VA loan at 2.75%, 0% down. Is it worth waiting to see if prices come down or soften, or better to potentially lock in with a low interest rate since the property will cash flow? In short, get in the game or hold for near term. By the way, hello from Reading, Chad says.
Chad, man, I'm so glad to hear from you. California, I just saw an email I think Rebecca sent you yesterday. So, man, it's great to hear from you. You said you knew the answer to that.
That's a no-brainer, I thought.
Yeah. And so what do you think they ought to do?
Get in the market. Get in the game.
Yeah, Chad, listen, regardless of where the economy is generally speaking, I ran out of time to show you slides, and I didn't even send these slides to Derek today because of that. But I had a set of slides that shows how the rents have actually only fallen off. People paying rent has only fallen off just a little bit, and some of that has come from, in fact, in some cases, some markets, the rent is almost identical to what it was a year ago. In other words, the percentage of people actually paying rent that have, I know there's been this movement, where people will stop paying rent for the last several months, but I think here's the positive side of the stimulus is that if you compare rents to this time last year, they're not too far apart. Now, there could be, I'm speaking on primarily a national level. So there could be individual markets that are getting hurt more than others, as Karen was talking about on the purchasing side. So let me answer it directly. Listen, Chad, the 2.75, that's hard to pass. On a fourplex, that's hard to pass. So here's the kicker. As long as you're cash flowing after principal, interest, taxes, and insurance, my goal, because I know you and you're a dear friend, I want to get at least $200 a door positive cash flow. That's after principal, interest, taxes, and insurance. So yes, you can figure in vacancy and repairs, but that $200 a door will help cover that. Now, if you get down to 150 at 2.75, I would still do it. $150 of positive cash flow per door, I would do it in a heartbeat. So if it's less than that, just text me and I'll talk to you about it.
That's awesome. Okay, another real estate question here. Should equity be unlocked in advance from real estate? And I think what Deborah, this is from Deborah, what she's saying is this a good time to go ahead and pull equity out of homes to be able to use that cash for other purposes?
I'll let Dan and Mike answer.
Go ahead, Dan.
I always have my equity line of credits open. And the way my home equity line of credits are structured, it's 10 years interest only, and then per month, and then it's 10 years principal and interest. And so I make sure, with equity, I don't ever want to have lazy money, especially when a good deal comes up. So I encourage everybody to get equity, especially at these rates right now, like Becky talks, and Billy are talking about. At rates these low, where the Fed is basically giving money away for free, I would have those equity lines of credit open and ready.
Yeah.
Great. Thank you, Dan. This is coming in from chat. Several years ago, during a difficult economic time, big business began buying up family farms in the Midwest. Do you see something similar coming? And if so, will it be farms again or other types of real estate?
Oh.
It'll be any type of asset that either groups and or investment groups or corporations can make money at, and it depends on, I think, like ConAgra that's out there was buying up tons and tons of farms, and I actually knew about some of those deals. And so I think right now when it comes to real estate, there's going to be some opportunity. It just meaning, I know you're asking maybe from the protection side, but let me say there may be some opportunities for people to come in who do have money to be able to buy correctly. And if people are hurting, or if they're having to go through bankruptcy, anytime there's good deals. Now, as far as identifying the asset classes, of what's happening right now, basically, in my opinion, everything is being affected, but it's not being affected directly. And so what we have to do is just see, we've never been through anything like this. So one of the disadvantages of me showing you the charts from the history is that we've never really been through anything just exactly like this. That's why people don't know if we're going to have, honestly, at the end of the day, if it's going to be a V-shaped recovery or a U-shaped recovery or a W-shape or a long L. We just don't know right now because there's still too many unknowns. But I think from a standpoint of protecting your asset, if I don't see agriculture right now and farms being adversely affected. People have to eat, and in the supply chain, for the most part, it's still healthy, and stores are being funded. Now, how it may shut down on some of the foreign stuff and some of that kind of stuff globally, we'll just have to see.
Great. So this is a really good question on so many people's mind too. Jenny Lee she lives in the San Francisco area, so we all know how high the market is there. She said, if I'm buying a house now to live in, how do I determine if I'm not overextending myself in terms of price and monthly mortgage payments living in a market like San Francisco?
Dan or Mike, or I'll be happy to jump in, but you.
It looks like they're deferring to you. Oh, Dan popped on. Go ahead, Dan.
Well, one of the things about San Francisco, I think the last time we looked, the prices of a lot of properties were like 12 times median income. And so we usually, for a home that we live in as our primary residence, we don't want to pay more than 4 times median income. And so in some of these areas that are overstimulated with outside money, I'll just tell you that is out of my ballpark. So I don't even know how to buy right without violating my margins in what we teach.
Yeah.
Yeah. So let me say, that's good, Dan. So what we try to say in areas, that are what we call hotter areas from a real estate perspective, which San Francisco is. Let me do something. I know I don't have much time left, but always remember that real estate is primarily local and it's based typically on the local economy. So we like to see you be able to buy in that, as Dan just said, in 4 times income. San Francisco, even as we're sitting here right now, is somewhere, I think, between 10 and 12. So people say, well, then, how do you buy a house, or can you? Yeah, you can, because there's other ways to determine return on investment. So, for example, in San Francisco, you would get appreciation. So here's the way to do it. If you haven't bought a house, typically you don't want your total debt ratios in your life to be above 36%. That's all your debt. That's your house payment. If you want to be real conservative, your mortgage, that would be your principal, interest, taxes, and insurance, wouldn't be more total combined. The absolute top end would be 36%. And that is if you don't have other debt. If you have other debt, then you want to be somewhere around that 30% number. So, and 30% of your monthly income, just so I'm clear on what I mean by that. Excuse me, I'm sorry. As far as the value of the property, then somewhere like San Francisco, you're going to have to look at comparable sales and really understand and look hard, because you can still find what would look like a good deal, or is a good deal to somebody else may not look like that, just by really understanding the market and then looking for an opportunity that would be better. Now, because San Francisco, so let me say this, Karen, but what you have is you have Silicon Valley right there, right outside. And so a lot of that income and some other things around it that are pushing those prices up.
Mm-hmm.
And so what it does is it drives people out of San Francisco. So I would say in a normal advice is that start looking a little outside the city. The problem in California, you start looking a little outside the city, sometimes it still goes up, especially in those areas. So I would still look a little outside the city to try to get your, what we call the multiple times median income, a little softer than what it would be right in San Francisco. But that's how you know. I think she's asking. So you want to see, back before the 2007 recession, there were people, the mortgages that were being done. I'm not talking about those with non-verified income. I'm talking about with verified income. They were actually doing up to 50% of your income to debt for housing. But honestly, just to give you a round number, you never want to be above 40% total in your debt ratios of your monthly income, or you won't be able to live.
Great, thank you. I know we're out of time. There's just a couple more things to mention here, and then I'll turn it back to you to close. We've got a lot more questions that are coming, so join us on Facebook Wednesday at 1 p.m. Mountain Time, and Billy will answer more of those questions. There's a poll that is going to show up on your screen. And the reason we're asking you this is an interactive live stream. We are doing this to help educate you and answer your questions. And so we're just curious what topics you are most interested in. So if you just take a moment, it's a quick answer, and answer that poll, that would be awesome. If you click on a button, then it will disappear. Also, Rosanna Evett was wondering, she's interested in the real estate live stream. Rosanna, thank you for your question. And Rosanna is wondering how long the live stream will be available after the event for people. And we will have that live stream up for a full week after the event. So if you can't join us for every session, you have a whole week to be able to join us and view that live stream. And so with that, Billy and Becky, I'll turn it back to you to close us today.
Well, it's been a good one today.
It's been a good one. It's been a fast one.
Thanks for all the questions, and I can see the participants. Man, I think we got people from every continent joining us. It's exciting. And so we just want you to know that we appreciate that. Now, listen, I want to encourage you. We're going to pray for you before we go off here, but I want to encourage you to, we're going to be making some announcements on other live streams that we have coming up. And so we'll let you know. So if you're not subscribed to the email, we want to encourage you to do that. If you want to follow these, so you kind of know what we're doing, at last we're going to give you at least hopefully a week's notice on some of the changes. But then we also, of course, Facebook Live, you'll be able to see some things there as well. So, honey, it's been good.
It's been really good. So anyway, let's pray.
Let's pray. So we're going to pray for you this morning. So, Father, we speak blessing and increase over your people. We pray over their investments, over their jobs. We pray today over their families. We pray, Father, today over their income. And we just speak increase in favor over them today.
Amen.
In Jesus' name, amen.
Amen.
We'll see you again next week. Bye-bye.
Be blessed.